I came across an interesting article this morning from Go Banking Rates on MSN, and the title is What an Upper Class Social Security Check Could Look Like in 2025. And I'm always interested when it comes to Social Security because, well, as the trustee reports have shown, is that it is scheduled to run out of money to pay current level of benefits in the next, each year the number changes a little bit, in the next 8 years, let's say. So what that means is that Social Security, a lot of people don't understand how it works. People who are working now pay in for Social Security tax, and that money gets sent to the government. The government then sends that money out to the recipients of the Social Security income, and that's OASDI, Old Age Survivors Disability Income. And the vast majority of that is old age, so retirement income for people who paid in previously. So there's no sense in that it's not like you pay into Social Security and it goes into an account with your name on it. That's just not how it goes. It goes into a big pool, the pool gets paid out. Historically, what happened was that there were more workers who were paying in terms of total dollar of that value than were receiving. But we've had demographic shifts over the last several decades, and that is no longer true. Several years ago now, the Social Security fund started drawing down on its balance. In historically, when there was a surplus, the rest of Congress borrowed from the Social Security fund and gave the Social Security an IOU. So Social Security has been cashing in those IOUs to cover the difference between the money coming in Social Security taxes and the money going out in Social Security payments. Now, that on those assets, those IOUs are scheduled to run out here in the next 7 8 years, something like that. So what does that mean? That means that the benefits are not going to be able to be paid, and either taxes on Social Security need to go up, or benefits need to be cut, or some combination of the two. And that's just the reality. But of course, politically, it's not a popular thing to talk about because the people who are on the receiving end, the retirees, vote in very high numbers, and they tend to punish any politicians who talk about reforming the system in any way. Reagan did a reform, and basically the adjustment was that if you were young at the time, your retirement receiving date got delayed. And it used to be 65, then they pushed up to 66, and then 67. I think chances are we'll see something like that. However, when it comes time to receiving the benefits, how much does this actually matter? And that's why I was interested in this headline, why an upper class or what an upper class Social Security check could look like in 2025. Because if you think of Social Security in terms of an investment, even though cash flow wise it doesn't work that way, in terms of an investment, it's not great. The analysis that has been done over the years shows that basically it's sub 1% return on the taxes that you pay in. So if you have another choice, it's generally better. A lot of people don't have another choice though, because they're not making enough to have the surplus to invest. So that's a whole separate issue. But the upper class people do. It's the article's not long, so I'll just go through it real quick. Basically saying less than half of Americans in retirement believe they have saved enough, 44%. That 44% is probably correct. 24% are unsure, and 30%, 32% are convinced they have not accumulated enough savings. I think, yeah, that's probably correct. Additionally, according to the survey, nearly half, 47% of all retirees report their expenses in retirement are higher than they expected. And this puts the lie to the great financial planning promise. It's like, oh, you have to build up a certain amount of assets, and then when you draw it down, the amount's going to be lower than when you're working, but that's okay because your expenses also go down. And that is not really the experience that I've seen over the last many years. And 49% believed Medicare would cover more of their healthcare expenses. Okay, this is so Social Security and Medicare are tied together in terms of qualification, but they're two different programs. So it's critical when you get into Medicare that you talk to your insurance people about gap coverage because the standard A and B plans only cover 80% of the qualifying Medicare expenses, and that leaves 20% for you. So the gap coverage covers that 20%. And there are special rules around when you can buy this, and it's basically only at the beginning. Make sure you don't miss out on that window. It's a separate point, but definitely worth investigating. And it's going to be expensive because as we get older, medical expenses balloon. And I think I've seen statistics that are like 80% or 90% of spending on healthcare is in the last 1 or 2 years of life. So it gets crazy. Based on these numbers, it appears that even retirees who made good money in their working years are feeling worried and literally spent. Expanded Social Security benefits in 2025 would help everyone relying on Social Security in their golden years. What could an upper class Social Security check look like next year? And so from CEO of Sensible Money LLC, has over 25 years in the financial industry and has authored several books on retirement planning. She has a fairly positive forecast. Social Security benefits result in a good chunk of change for high income earners. Take the example of someone born in 1958 with income in excess of the Social Security wage base for at least 35 years of their work history. Okay, so that right there means we're not talking about many people. So the way the Social Security tax works is that it is assessed on wages up to a wage base. And this year is $169,000. The numbers have changed over the years because of inflation. But if we take this year's 169,000 and say, okay, how many people are earning above that so that they paid in the max? And how many of those people are paid in the max for 35 years? A standard working career is going to be 40 years or so. So, who made a ton of money right at the start of their career and continued to make a whole ton of money? It's not that many people. So they can expect approximately 4,018 per month if they claim in 2025 at age 67, a few months after their full retirement age of 66 at 8 months. Okay, this immediately sparked a question in my mind. Is how many people are we talking about here? So I went into the Social Security publications. This is SSA.gov. You should have an account at SSA.gov if you don't already. And there's a report, taxable maximum earners. Every year, roughly 6% of covered workers had earnings above the taxable maximum. Almost 20% of the current and future covered workers are projected to have earnings above the taxable maximum in at least 1 year. About two-thirds of aged beneficiaries who are projected to have earnings over the taxable maximum in at least 1 year will be in the highest shared earnings earnings quintile in 2050. Okay, so the 2050 part doesn't matter so much. But what these two charts are saying is that in any year, roughly 6% of the people qualify for this excess of Social Security wage base. The fact that a given person has a 20% chance of being in that 6% chance, what that tells us is that it's not the same 6%. People have good years, people have bad years. Okay? So there are high income professions, your high end doctors, your successful lawyers, and all that kind of stuff that will earn above the max throughout their career. People in the tech field these days are also in that category. But the most of the people who end up having good years, they pop into that Social Security max level and then they pop back out. Maybe it's good 2 years, maybe good 3 years, whatever the case is. But if 20% of people hit that max in a given year, but only 6% overall, there's a big spread there between the people that are qualifying overall and the total numbers that qualify. Okay, we're not talking about 6% of the population who are in this. We're talking about something dramatically less. It's probably something more like 1 or 2%. So yeah, if you're in the 1 or 2% of top earners throughout your entire career, then yeah, okay, you make an extra 4,018 a month, which works out to $48,000 a year. Okay, but let's think about that for a second. If you have been a top income earner your entire career, what does your lifestyle expense look like? It's way above $48,000. Okay, and it will continue to adjust annually with consumer price index, COLA adjustments, cost of living adjustments. That's all true. That's true for everybody. If they wait until 70 to begin benefits, their monthly amount is likely to rise to 52, 61 a month, or $63,000 per year, assuming 2% annual CPI increase from now until then. And this is where if you delay your initial distribution from Social Security, you get rewarded. They increase your monthly benefit. Now, whether the math works out on that or not depends on your life expectancy and all that. So it's a little bit hard to say whether that is a good idea or not. So if you take it early at 62, you get penalized in terms of the monthly amount. Then there's the full amount depending on your birth date as far as what age you qualify. And then if you delay, then they'll pay you more. So there's a big sliding scale of about 50% between the low end and the high end as far as how much you could earn per month. But so this is when I look at Social Security, there's always a conversation with our clients about how much we want to put in. And there's two basic cases. So one is that most people want to pay as little in taxes as possible. And that means necessarily that we're putting in less into the Social Security system, so your benefit on the back end is going to be lower. However, your money in your pocket this year is going to be higher. And which of those is worth doing? And I think when you look at the Social Security from this perspective of the high income earners, is okay, great, you make an extra $48,000. that is some sliver of your lifestyle spend in retirement. And that is actually the same experience as what we find throughout the income spectrum, that Social Security only covers a chunk of the lifestyle spend, at least that you want to have. Some people are forced into only spending what they make in Social Security because that's all they have, which is not a situation you want to be in, but it is a common occurrence. So the net result is that people who are relying on Social Security for the bulk of their retirement spending are going to be very disappointed. And it's important to know that going in. So when you're doing tax strategy on the front end here, when you're still working, how can I adjust my income so that I'm able to put more money in my pocket now, save and invest for myself, and not rely on the Social Security system? And there are ways to do that. And the other element is that there is one circumstance where you want to pay more. And that comes in, we've seen this many times throughout the years, where somebody who is an immigrant who doesn't have a work history needs to pay more. And so the the rationale there is that in order to qualify for Social Security at all, or to qualify for Medicare, which is actually the bigger component, you need what's called 40 quarters of coverage. And what that means is that each year the administration puts out a minimum amount that you have to pay Social Security and Medicare tax on in order to have a quarter of coverage. And you can have up to four of them because there's 4 quarters in a year. So 10 years of paying into the system at least a minimum rate will qualify you for benefits on the back end. If you're an immigrant, then the Social Security portion can be reduced based on other income, other retirement income you might have from wherever your home country was. There's some finagling to do there, but the more important thing is the Medicare piece. So if you have, this happens a lot with people who bring over their parents. So let's say you're 45, you come to this country for school when you were 20 and you stayed and you're now a US citizen and all that kind of stuff. And you decide to bring over your parents because you just want your parents here. And they start working small jobs or maybe they're self-employed. So, just to help make ends meet. This is a very common situation. And it is something that's worth planning for, in that we want to make sure that we're earning enough to at least cover 4 quarters of coverage each year. And what that means is that you have to pay in a certain amount. What is that amount? Well, let's see. So here is the Social Security Administration telling us that the earnings required for quarter of coverage in 2024 is 1730. So that's for 1 quarter of coverage. And then there's four of those. So 1730 times four is $6,920. So this is the minimum amount that you need to earn in order to get 4 quarters covered for 2024. And that means paying tax of, I'm just going to simplify here, of $1,100 around it. But you got to pay in at least $1,100 a year for 10 years, and the number changes a little bit every year, in order to be able to collect anything on the back end. And again, the Social Security part, not the most important because it's going to be minor and it's not going to cover much. The more important part is the Medicare portion. So we had a client this past week that we were talking about with this issue. And so brought his parents over a couple of years ago. His father is 75 and has no earnings history in the US. So we started talking about this issue. So he has enough income to qualify for quarters of coverage. However, it's self-employment income. And the question becomes, how much do we want to, of the expenses that he has, how much do we want to apply to the current year? Because the way the code is written is that you're not required to deduct all. You are required to declare all your income. You are not required to declare all your expenses. You can, but you don't have to. So you can elect to pay more tax if you want to. Now, you just can't elect to pay less tax than you owe. That's the thing. So you get it one way, but not the other. We started having this conversation about, do you want to start paying in so that in 10 years, when your father is 70, when your father is 85, to be able to be eligible for Medicare? And at that point, it's pretty debatable because what's the life expectancy? What's the health insurance situation? Because the alternative is that at 85, you keep them as a dependent. And obviously, they live together and all that kind of stuff. And you just have to carry the cost on your health insurance. Or he just doesn't get medical care. I guess that's the final option. But that's not likely. That's not what we want for our parents. It's important to be aware of these issues and to have these conversations and figure out, in your particular situation, what is the right way to go? What is the optimal way to go? Because everything comes down to trade-offs, and those trade-offs are going to depend on your facts and your circumstances. So this is why I always talk about how it's hard to give general advice because it depends. And these are the kinds of things it depends on. It's just one example. But I thought this was interesting since that article popped up in my feed at this moment. If you want to talk to one of our tax experts about your particular situation, go to taxsherpa.com, click the book an appointment link, and you can get on our calendar, and we will go over your facts and your circumstances and determine what is the optimal way to go for you.